Fannie Mae releases updated projections based on an increase in inventory, a decrease in mortgage applications, as well as rate cut expectations. Stick around, I'll share with you what to expect for the rest of 2024 and 2025, and most importantly, how San Diego is looking based on these projections. Case-Shiller, the gold standard for market analysis, regardless of them being lagging data, dropped their report for April. In addition, the FHFA Federal Housing Finance Agency also dropped their report for April on the same day. I'll share with you what they are reporting on and what you should keep an eye on in the near future. To finish this week's report off, I'll go over what to expect in the rental market in the future, and as a heads up, it's not good news for some people. All of this covered here in this week's San Diego Market Matters. I'm Karl, your San Diego realtor. Let's jump into it. Real quick, if you appreciate the information I provide in these videos every week, I'd appreciate it if you would subscribe to the channel and like this video. And if you're thinking of selling or buying here in San Diego, check out the link I have in the description below where you can schedule a meeting with me so we can discuss your goals and how I can help you achieve them. Now, let's dig into this. Fannie Mae releases their economic developments report for June of 2024, headlining home sales to remain sluggish in 2024 as buyers run up against affordability constraints. Based on recent inflation data, Fannie Mae sees encouraging numbers and expects core inflation to continue to gradually go down, but claims that the data is noisy. Now that's an interesting choice of words. This is consistent with what I've been sharing with you in the past San Diego Market Matters videos. Downward trending inflation is barely starting to show up, so it's too early to know if for sure inflation is on a downward trend or if the recent downward trend data is only a blimp. Jerome Powell has held the Fed funds rate in place for months now and believes that only time is needed for the elevated Fed funds rate to make its impact. As for home sales data, Fannie Mae reports weaker than we had previously anticipated. Fannie Mae had projected 4.89 million national home sales in 2024 and now have adjusted that projection to 4.82 million. In addition, they modified their 2025 projections from 5.29 million down to 5.27 million in total national sales. So a slight decrease in sales, and this is why their headline pointed out affordability constraints. I'm working with a couple to buy their first home. They are qualified up to $600,000, and that affords them a 2-bedroom condo with 1 to 2 parking spots. Most of the time it's 1. Their HOAs are going to be between $450 and $500, and rarely will it include an in-unit washer dryer. This is an example of an affordability constraint. For my clients, they're fine. It's only the 2 of them, but imagine a small family. A small family would have to look closer to $700,000 starting for something slightly larger with an extra bedroom, while hoping it comes with at least 2 parking spots and in-unit washer dryer. Fannie Mae goes on to say that due to a continuous rise in inventory, all the while a lacking corresponding rise in sales, some areas of the country are beginning to experience a more equally balanced market between buyers and sellers. As a result of this balancing out, this is why Fannie Mae believes that there will be a deceleration in price growth over the rest of the year. How very interesting. A balanced market can be a sign of an impending shift, in our case, from a seller's market to a buyer's market, but this isn't always guaranteed. If the Feds do an adjustment to rates, we may see the market pick back up. And to be honest, I think that this is a real possibility, and here's why. We are seeing many consumers hoping that rates will settle in the 6 to 7% ranges. If the Feds adjust the Fed funds rate and the market responds appropriately to lower mortgage rates, we may see not a ton, but rather a reasonable amount of interest come back to the market from buyers who want to take advantage of rates while they can. Not out of concern of them going back up, but out of concern that if they hold off any longer, they'll be priced out of the market completely for a really long time. Fannie Mae believes that in 2025, mortgage rates will settle around 6.4%, and as a result, this will spur existing home sales upwards as well as new home sales. New home sales being new construction homes coming to the market, which here in San Diego, we don't experience much of. How does all this data compare to San Diego? As you may know, if you follow my channel, inventory has been on an aggressive rise since December. At the same time, the number of homes sold as well as the number of homes going into escrow are both on the rise. Inventory is still outpacing the number of homes selling though. So what does this mean for San Diego? Unlike the data Fannie Mae is seeing, where some areas are approaching a balanced market, San Diego is not one of those areas yet. If mortgage rates continue to hold at 7%, we could see affordability become a pressing issue for entry-level buyers as soon as the new year of 2025. With prices continuing to climb, interest rates holding, getting into a home may become even more difficult for first-time buyers. Now let's move into the Case-Shiller and FHFA indexes. The S&P CoreLogic Case-Shiller Index, holy crap, that's a long title, reports for April 2024 on price growth. Hold up, April 2024? We're practically in July. That's right. Case-Shiller is the gold standard for providing the most comprehensive and intensive researched reports. As a result, it takes them almost 3 months to compile that data and make sense of it. Regardless of being lagging data, this report is still extremely important. Being that the Case-Shiller report is so extremely comprehensive, it gives us the best understanding of where the market was and how it is trending from the previous months. There's still plenty of insight to take away from this report. Case-Shiller reported a 6.3 annual gain in April, down from 6.5 the month before. That's right, a slight decrease. It gets even better. Case-Shiller goes micro in the reports and does a 10 and 20 city composite. These 10 and 20 city composites are reports on the most densely populated cities across the US. This gives us another perspective on what the major populated cities are doing relative to the state of the economy. The April 10 city composite came in showing an 8% annual gain in property values, which is down from 8.3% the month before. The April 20 city reported a 7.2 annual gain, and that was down from 7.5% the month before. This validates what we're seeing in real-time data, that prices are starting to cool off. Not dropping off a cliff, they are cooling off. A 6.3% annual gain is still a really strong number with only a slight step down from March. And here's another detail to consider. March to April, you would typically expect the market to go up as we are well into the spring. That's not what we're seeing. This means that with the inventory going up, there is more buyer hesitance. So how did San Diego show up on this report? Great question. San Diego leading the way again with the largest increase in values at 10.3%. But guess what? In March, the month before, San Diego reported 11.1% increase. So it's even happening to us. April marks the 4th month of double-digit growth for San Diego prices based on the Case-Shiller report and will probably be the last one for a while. I bet heavily that we'll see single-digit growth in San Diego in the May report. Now on to the FHFA's report. The FHFA reports a national 6.3 annualized gain for April, spot on with the Case-Shiller index. This is really great news to see that these two sources are matching and for them both to be identifying the same market trends. One of the things that FHFA does a little different in the report is that they assess growth based on regions. As you'll see here, all regions experienced really strong growth over the last year, most over the last 2 years. Here's something you want to take note on. 2022 was when the Fed essentially said, this inflation, we're jacking up rates. So what happens between 2022 and 2023? We see less growth in most areas, and in the Pacific and Mountain area, it's negative. But what follows between 2023 and 2024 is stronger growth in prices. What this tells us is that consumers came to terms with interest rates being elevated and probably had strong faith in their investment into real estate. Typically, when consumers become scared of what is happening in the market, they hold their cash. We did not see that in these numbers over the last year. With growth starting to cool off, we can interpret this as more likely an affordability issue. For clarity, before you or someone you know radically misinterprets this info, prices are not coming down yet. What the data is saying is that they are not going up as fast. That's all. That's what I mean when I say the market is cooling off. Going forward, if the Feds do not cut rates, you will likely see this 6.3 annualized gain come down in very small steps through the rest of the year. To close things out for this week's San Diego Market Matters, let's look at rental trends. This data graph is pulled from the FHFA monthly report and has an owner's equivalent rent overlaid on it. The blue line is showing you how home prices gone up over the last 30 plus years, with only a drawback between 2008 and 2010. 2012 due to the world's financial crisis. If you're waiting for one of those to happen again before you buy, you may be waiting for a while. More importantly, check out the orange line. This is the owner's equivalent rent. The difference between these lines, the blue and the orange, is the difference you would pay if you were a renter or an owner. Over the last 30 plus years, rents have primarily increased, even when the market has gone through a recession. As a matter of fact, every time the market has drawn back, rents typically rise. Here's what you want to take away from this. Costs will never go down for renters, even when we go through a recession. On top of that, as an owner, if you hold long enough, rents will increase to the point where you can rent your home out and cash flow. You gotta understand that real estate investing is a long-term play. Over time, your home's value only goes up, either for resale or as a rental. It's a no-lose situation. That's a wrap for this week's San Diego Market Matters video. If you found this information valuable, be sure to hit the like button and subscribe to my channel for weekly updates on the San Diego real estate market. And if you're considering on buying or selling property here in San Diego, don't hesitate to reach out to me for expert guidance tailored to your needs. As always, I'm Karl, your San Diego Realtor. I'll see you in the next video.